Okay, we're going to get into a little more complicated trade idea that I brought up in Mitch's Discord based upon his SPX trade setup. So, if you guys don't remember, I had done, it was basically an 8-legged option, but it's basically buying two put debit spreads, 333 to 323, 320 to 310, and then we're selling a call credit spread, 340. We're short the 340 call and long the 344 call. So that's going to immediately give us a credit and reduce our cost. But basically, our option buying power, we're responsible for that $400 spread. But whatever we receive in premium, so $9, $250. So basically, our max risk here for a $4 spread that we're getting $2.50 or $250 for is $150 max loss if we're just selling that straight up. And then we have two bearish put spreads down to the bottom, put debit spreads down to the bottom. So I'm selling some premium underneath it at the 309. So we have a 333, 323 put debit spread that we're buying. And then there's a second take profit area. So we're buying another 320 to 310 put debit spread. And then that's the third, basically, that's your final take profit area. So to reduce this cost, and when you sell these little premiums, if price just absolutely dumps, yes, it's going to take away from a little bit of your max profitability, but it's going to set your costs so much lower. And since you're already selling the 340, 344 call credit spread, they're called bear call spreads, vertical credit spreads, vertical call credit spreads. I just say, if credit means you're receiving premium right away to sell that trade, or it's reducing the cost if we're doing it in combination with others. So we'll go back to Robinhood, and is Robinhood going to load? Okay, dang it. Alright, so let's go. I don't know how many trades Robinhood will let you put in. Did a previous video on Tastyworks, which is the easiest platform for me, but I'd say if you're looking for one platform, probably Thinkorswim is your best overall platform. So we're still on expiring November 20th, buying the 330. Oh. So make sure these are on and off. And you have to use the desktop version of this. I think the phone version automatically sets spreads for you. So I think on this one we were doing the 333, 323. So let's go and do that. So buy the 333. I want to see how many they're going to let me do. Sell. Make sure that's all you need to do is go over to the sell part. 323. And then we're going up to 340, 344. So just go over to call. And this will all be executed at once. So we're selling the 340 call. And you have to have these turned on with Robinhood, and every site you have to have them turned on. You just need to have spreads available. You don't need to put the max on. So It's not what I wanted to do. So you can always see buy, sell, make sure that those are on the right side. So if I'm selling a 340 call, I'm going to cover it with a 344 call. So that's the stop loss of the trade setup. So we're going to sell some premium to reduce our cost. 345. So I'm just wondering if Robinhood just lets you put as many trades in as you want. That'd be awesome. That'd actually make them somewhat of an interesting site. So if I can I buy, let's see, most options platforms will not let you put more than 4 trades in at once. So yeah, but $1.45 is our cost there. So, and I can go to the other side. Like I said, it's an 8-leg thing, but see if I can double log into Robinhood and be able to compare prices. I don't know if it's going to let me. So I don't really want, I have a few $100s on Robinhood. I don't really trade there. I think they rip you off a little bit as far as prices. So how many contracts do you want to do? I'll do 1. And since I don't, so it's 130 to 160, that's called the bid-ask spread. So you can go right in the middle, which is what it automatically does to you. You can go down to 130. Like I said, I don't really want this trade, but I guess I can go in and cancel them later. So I'll go ahead and put good for day in, review it, and I don't know if it's probably going to be good for just Monday. Good for day and GTC, good to close is generally what I use. Good to close means until you tell the trade not to happen, it's going to go ahead and do it. And I'm using new recording software. I have OBS. I'm not on my regular computer. I'm on the laptop. So I don't know why this is taking so long. Maybe just because it's in the weekend. So okay. So yeah, I don't have over. You need $400 of premium there. So the collateral. So you see that. So, but we have that trade idea there, and then the other part was buying a 320 put. It's not letting me do anything. Okay, so 4 trades is as much as you can do. So this trade is costing about $1.45, anywhere from $1.30 to $1.60, as of close on Friday, for 333 to 323, I think is what we're doing on this one. So it's a $10 spread. So $1.30 to $1.60 to get back a max of $1,000 if price breaks all the way through. And say price expires at 308, you can just leave it there. But you're generally going to close options well before expiration. You're not going to get assigned shares, all that stuff. Doesn't happen. It goes to market makers, sell it to big banks who use it to offset, to hedge current positions. So getting assigned stock on options doesn't happen anymore. If you do let it go through expiration, it'll auto exercise for you. So just make sure to close out option contracts at least, I'd say at least 4 hours before the close on that Friday. I generally would like to close a lot earlier than that. Time is money in options. So we're going to go ahead and dismiss this trade, but it costs, let's say it costs us $1.50. So I don't know how I can erase this trade, but let's. So that's costing us $1.50. It would generally cost us three. I don't know. I'll tell you right now. As soon as the put spread prices come up. So we bought a 333 put, which would have cost us $1,300. $13 times 100, and sold this, so 957. So it cost us $343, and instead it costs us anywhere from $130 to $160. And it's just using like the stop loss. Like it said, it gives you, it reduces the cost on this. But normally it's a whole nother video for me to go into just selling premium, which I don't really want to go too much into. But yeah, you get the money right away. You're just responsible for it. So the other part of it, so we had bought a 333, 323. So we bought long the 333 put. So buy to open November 20th, 333 SPY put. Sell to open November 20th, 323 SPY put. And that's a put debit spread. And then we're going to buy to open. I'm going to say buy to open because I know there's people that use Schwab and it uses that type of stuff. So we're buying a put, and then we're going to go sell a put. So we're doing 323.10. So we're already into this trade for, let's say it was $1.50. So now this is going to add on to it. This is going to make it $395 or $395. So the way I reduce a little bit of the price is I'll go generally right under my take profit area and go ahead and sell some premium. So since it was asking for $400 collateral, it's going to hold $400 collateral. If you sell that call credit spread, you can sell a put credit spread, and it's going to hold the same collateral because you're doing it on the same expiration, the same ticker. Price can't expire either above 344, or what we're going to do here is sell a 309 put and buy back the 305 put. So it's not going to require any more collateral. We're already giving up $400 collateral, but this is going to reduce our costs a little bit. So you have to make sure to do, if you have a $4 wide spread, you have to do it on both sides. So this brings it to $1.65 plus $1.50, so $315. And our max profit was and these prices are going to be a little bit different. So $1,815. So I'll do it on options profit calculator just now, just to see. This is a great site to use. It's going to use bid-ask spreads from probably the NASDAQ. So it's going to get kind of wide spreads, but we'll do the 8-leg strategy that we just did, and I'll use these ones. I'll just use the mid price. So, and we'll get the new, because we had some price move, we had some volatility go up. So we're going to buy this is the 8-leg one. That looks really complicated. It's not that complicated. So I'm always going to use the mid price here. So there's a bid, ask, and a mid. Just the average is 2. So with options profit calculator, buying is being long an option, writing is being short an option. So long the 333 put, it'll keep the date. Short the 323 put, I can just keep doing. Buy the 320, 310 put spread, put debit spread. And if you actually do strategies up here, it'll put like buy sell. So if you do put spread, call spread, it'll do it as a debit spread, credit spread. You can do iron condors and basically sell a call credit spread and buy tops that put debit spread is what we did earlier. So write the 310. I guess we can just go ahead and write the 309 here. Like I said, this part is not something you necessarily need to do, but it gives you $80 to reduce the cost a little bit. And if price comes falling down a little bit, or as if price just kind of doesn't absolutely tank and doesn't pick up velocity, this can get to a point where you can just go ahead and buy it back. So if you sell like a call credit spread or a put credit spread, you're going to probably eventually want to buy it back. If it gets down to where it's at 10 cents, I always auto buy back, but I usually have a preset of what I'm going to buy it back at if I'm just doing that trade. Wow, what did I do? So I want to buy the 305 put spread because we're going to do a $4 call credits, $4 wide call credit spread. So I'm selling the 309. So this is going to take up $400 of collateral, $4 spread. I'm getting 80 cents for it, but I'm going to go here and sell the November 20th SPY 340 call to reduce the cost of this trade. So I'm going to get $10.03. And I think the stop out of the trade is 343, something like that. So even if price runs up, wicks above it, you still have until November 20th for this trade to play out. So I'm pretty comfortable with it. And if this really goes wrong and price moves up, you can PM me. It's very easy to get out of. It's called rolling. And you can just roll this to the next month, and the other part of the trade is going to go bad for you. But selling premium is not a selling naked premium is a much higher risk thing, but this is not selling naked premium. So I'm going to calculate the graph range. Like I said, this is just buying two put debit spreads because we have two basically take profit areas based upon Mitch's trade setup. And then we're selling a put credit spread just below our last take profit area just to reduce the cost. It can cost us a little bit of money, but not a big deal. And then we're definitely selling some premium above it. So as we get here, entry cost is $308. The max risk is $708, so $300 entry, $400 of collateral. And so if price doesn't even go up near there, we don't have to worry about it. So your max profit is about $1,700. It's probably never going to be realized, but if I look at, I'm risking $308. Yes, I know I have to put up $400 of collateral, if I'm getting $1,000 back, I mean that's over 3 to 1, so I'm happy with that. And if you look at all the areas, you're getting over 1,000 back. And if you go to this options profit calculator area, it shows you. Now this doesn't take into what's called the Greeks, but it shows as you're getting closer towards expiration, you have some higher profit areas. I don't want to get too much into it, but you get some really increased volatility. So I'm spending a little over $300. So I'm looking to get out. What was the cost? 308. So if I wanted straight 3 to 1, I'm looking for 924, and where I can start getting that, and you'll start seeing it kind of an upward slope angle. The quicker price drops down, the quicker it normally get there. But since we have some puts down there, and volatility is going to increase a ton, but let's just say that it only takes 2 weeks and SPY has dropped down to the 310 area, and we're in mid area. So how to get out of that trade, it tells you everything you want to do and what the implied option prices are. It doesn't take into account the VIX moving up or anything like that. But so the entry cost is $308. You're getting back $653. So it's telling you your 323 put debit spread is now worth $674. And you originally paid, I think the cost was $350, but since we sold that call credit spread, so that you can buy back here for 57 cents or $57. So we can buy that back. This put debit spread, yeah, we sold into that, and that's what's eating up some of the profit. So if I go and move these around to where they're not nearly as close, or I can even change the date on them. So I'm collecting a little bit of premium, but they'll expire before this expiration, and then I don't. But I hate this website. It does that. It'll only show me through that date. So I'll put these at something that's really not likely, but so what is this on the buy side? Okay, so I'm selling a 284 put, so I'm going to buy the 280 put, and this will get priced. This will get a little more realistic. So like I said, you can leave this part out, or if price starts dropping, you can sell a little bit underneath there to lock in some profit. But let me go. What did I do here? I'm selling a 280 for 280 put credit spread. Okay, there it is. So I'm receiving that a lot. I'm receiving $34 for that, but you'll kind of see the difference in the profit ranges. So as you see, 310, we're getting up into the $900 range as it gets to November 5th. Like I said, we're selling some premium, so it's going down a little bit. But if it goes really quickly and we have 290 being the lowest, I can move that a little bit down because we're selling premium down there. So I can show you what happens if basically it gets down and breaks past that 284 put. So basically you see that the profit jumps stop going up so much. But I said we're looking for a move down to first take profit area on this is I don't want to post the trade setup really, even though I kind of have. First take profit area 323.21. So if that happens in 2 weeks, we're looking at this area right here. So there's some other. So we're looking at October 16th. $323, $321 area. So we'll go. This it's going to tell you how you would exit the trade. So your 333, 323 put debit spread is now worth $484. Your 323.10 put debit spread that cost you $2.50 is now worth $329. The put credit spread, which I think you got like 38 cents, something like that. It's still not bad. It's only costing you. You can buy it back for $35, and I forget the premium. It was like $3.50, and it brought it down to $1.50. So we got about $2 in premium, and basically we can buy this call credit spread. So this part right here is the call credit spread, the highlighted part. So it doesn't show us what we bought it at, but now it's predicting price. The 340 call is going to be $417, and so we're short that, so it's going to cost us $417 to buy that back, but we're long the 344 call, and it's going to give us about $300 premium. So this would cost you $122 to buy back, and I think it gave us about, like I said, I think it gave us $200 premium. So there's $50 in profit from there. So I'm going to end this video on that.